covered call is an option strategy that can help investors earn additional income on securities like stocks or ETFs that they already own. Many investors sell covered calls because they have lower risk than other option strategies. A covered call strategy involves an investor owning or buying shares of stock and selling call options, often at a strike above the stock's current price, in order to collect premium. If the stock's price rises above the strike price of the sold option, and the option is exercised, the covered call writer is obligated to sell the stock at the strike price. If the stock price does not rise up to the call's strike price or decline by more than the premium received, the trade can make money. For example, suppose there's an investor who owns 100 shares of stock at $100 per share. After analyzing the stock's price movement and trend, the investor doesn't think the stock price will rise much in the next few months. So, he decides to sell a call option with a strike price of $105 on his stock. For selling this option, he earns $300. Now, depending on what the stock does, one of two things will happen. As long as the stock price doesn't rise above $105, the option will expire, and the investor keeps his stock. However, if the price goes down, he could lose money on his stock. But any losses could be partially offset by the option premium, less any commissions and fees. But if the stock does move higher than $105, the option would likely be exercised, and the investor would be forced to sell his shares. However, he still profited from the shares increasing in price, plus the option premium, less commissions and fees. But keep in mind, there is a risk of missing out on further gains if the stock goes up any further. There is also the risk of the stock's price going down, but that can happen anytime you own a stock. A covered call doesn't just bring in income on stock you own. Some investors buy stock and sell a covered call at the same time. This is called a buy right, and it can help lower the effective cost of purchasing the new stock. Let's look at an example. An investor is interested in a company that is trading at $100 per share. The investor decides to buy 100 shares for $10,000. If she writes a covered call at the same time, she'll earn a $500 premium, reducing the cost to $9,500 plus commissions and contract fees. Now suppose she was able to write a covered call every month and receive a similar premium amount each time. As long as the stock price stays below the strike price of the covered call, the premium she'd earn over time, less fees and commissions, would help make up for some of the cost of the stock. Of course, there is no guarantee that a covered call writer can consistently accomplish this month after month. Short options can be assigned at any time prior to expiration. If you're interested in learning about other option strategies, we're here to help.